Salisbury's mortgage expert with Andy Munns and Adam Nanson.
Hello and welcome to the first ever episode of Salisbury's Mortgage Expert. I'm joined by Adam, who is Salisbury's Mortgage Expert. Adam, can you please explain to our lovely listeners why you are Salisbury's Mortgage Expert? What experience and skills you bring to the party?
I've been in the mortgage business for over 20 years. I've seen a lot of changes in the market, right from the mortgage crash through to the way that lenders now assess affordability. I've worked from admin through to mortgage advice through to managing a team of 15 people and now running my own business. So I think I've got quite a lot of experience that would help me advise clients the best way possible.
So the aim of the podcast is to break down the mysteries of mortgage, if you like, and keep things nice and simple, talking simple language and things like that. So we're going to start this time because of what's happened to mortgage rates over the last 12 to 16 months. A sharp increase in mortgage rates. So lots of people are worrying when they come to the end of their current deals if they're on a fixed rate. What's kind of the best way to deal with that? What's your advice for people who've, say, got 6 to 8, 9 months left on their mortgage deals at the moment?
Don't bury your head in the sand. Look at your paperwork. Find out when your deal is coming to an end. If you're not sure, just phone the lender. They will tell you straight away. And then seek out advice. Find out what the best solution is. Don't be frightened. Rates are coming down. There is an air of positivity around at the moment. Rates are coming down. Obviously, they're nowhere near as low as they have been in the past. But as a broker, we can look at every situation and figure out what is going to be the best solution for you going forward.
And with those increasing rates, has there been any change to kind of lending criteria, the processes that people are going through? Or is it all very similar, just the kind of goalposts have shifted because of the rates?
Yeah, it's very similar. The banks are being a little bit more cautious. So some clients find it easier to get mortgages in the past. Now they look closely at bank statements. So, there is an air of caution there. Just watch what you spend. Keep your payments on time. If you start bouncing direct debits and things like that, then that could cause a problem. So be careful with those things. And
I'm guessing keeping unsecured debt as low as possible.
Yes.
In the run up to your remortgaging is the best way forward.
Absolutely. Always. Yeah. And part of hitting this early and looking at this early is that if there is a problem, you've got plenty of time to address it before we can actually make that mortgage application.
And how are deals looking at the moment? Is it a bit of a strange market, or is there kind of some patterns starting to emerge?
Yeah, there are some patterns. So the 2-year fixed rates have dropped significantly over the last couple of weeks. 5-year fixed rates are lower than 2-year fixed rates now. So that kind of indicates that the banks are seeing a bit of light at the end of the tunnel and things are improving and the landscape's getting better. So yes, things are looking good.
Is that off the back of Bank of England keeping things fairly steady for the last couple of months?
Absolutely, yeah. So, and that's been because of inflation. So inflation figures have dropped. They're not quite as low as what they expected, but they're still low, and it's heading in the right direction. So the Bank of England has had to pause raising interest rates, which is great. Keep the cost of borrowing down. Banks are getting a bit more comfortable, so they're dropping their rates as well.
So when people come to the end of their deal, they have a couple of options. They can either switch to the variable rate, which is defined in their mortgage terms, which will vary depending on what the interest rates are doing right then, or they can refinance and look at other deals. What's the difference between, say, switching to a variable rate and a new deal on a tracker, for example?
So the variable rate is controlled by the bank or the building society. They have ultimate control. They can decide to increase it, decrease it, regardless of what the Bank of England does. Ultimately, though, 99% of the time, it tends to follow the Bank of England base rate. They're just a little bit behind. And it tends to be the traditional building societies that offer the variable rate products. Trackers are directly linked to the Bank of England base rate. So they will shift as soon as the Bank of England makes a move. So you've got a bit more certainty with that. You know exactly what's going to happen with the tracker rate.
So with a tracker, they'll say you're 1.5% above base rates, whereas a variable, the base rate might stay level, but they might add half a percentage point on top of your variable because they feel like they need to as a business.
Yeah, so what building societies tend to do, they have a standard variable rate, which is The average is probably around 7 or 8%, and they will give you a discount off that for a period of time, 2 or 3 years. And of course, that variable rate is set by the building societies. So they tend to move it in line with the Bank of England base rate, but they can sometimes be a bit late or a bit early, depending on other things within the building society, because it's also linked to savings. And if they want to offer good savings products, then they want to keep that variable rate high.
Okay, so when you come to the end of your deal, you've obviously got some options, especially within fixing. You mentioned just a second ago that the rates are varying and they're actually lower for the longer term deals. And I know this will vary customer by customer, but it's kind of some grand scale generic advice for people who are approaching the end of their mortgage. Is it probably better to fix longer term at the moment, or depends on, I guess, personality traits as well? People who are a bit of a gambler.
Yeah. There's two things, your appetite for risk and also your future plans. So what I always tell my customers is that don't try and base your decision on what you think interest rates might do. Not everybody has a crystal ball. Nobody has a crystal ball. And even the economists and experts get it wrong. So the key decision is your appetite to risk. So if you don't like taking risks at all, take a fixed rate. And if you have no plan to do anything in the future, in the near future, in the next 5 years, for example, like move home, borrow more money, things like that, then you take a longer term fixed rate, something like 5 or 10 years, because then you know exactly what you're paying for the long term. You don't have to look over your shoulder and worry about remortgaging in a couple of years. But if you want flexibility because you might move in 2 years, or you think you might borrow more, or you've just met somebody and you might need to do something different and you need to change your mortgages for whatever reason, then take a short-term fixed rate, something like 2 or 3 year fixed rate. So those are the key things. If you like taking risks and you're a bit of a gambler, then tracker rate could be quite attractive, because if rates drop as everyone is predicting they will over the next 2 years, then you could save quite a bit of money. But it comes with a risk.
And with a tracker, is it like a fixed? Are you in for a period of time, or is it kind of get out when you want to get out?
Yeah, so some give you ultimate flexibility. So you can take a tracker and then chop that deal in 6 months down the line. There's no charges to do that. Those are great because it gives you best of both worlds. You can take a risk, and then if things take a turn for the worse, you can change it to a fixed rate. Others will tie you in for a 2 year period. Generally, that's the most common 2 year tracker. So they come with small early repayment charges generally. So those, word of caution on those, because if you're worried about things, if you want to take the risk but you might want to get out of that, then don't tie yourself down for 2 years on that tracker.
Great, loads of really useful advice in there. How can people get in contact with you if they're either worried or they need some mortgage advice and they're coming to the end of their deal and they're looking to remortgage? What's the best way for them to get in contact with you, Adam?
So you can call us anytime on the office. Some of us have mobile phones. You can contact us in the evenings if need be. Email, and we're on social as well, on Instagram. We're on Facebook and LinkedIn.
Lovely. We'll include all of that in the description and the titles. Thanks for your time, Adam.
No problem at all.
This podcast has been brought to you by Your Mortgage Expert. To find out more, call them on Salisbury 322 683 or visit your-mortgage-expert.co.uk. A mortgage is a loan secured against your home. Your home may be repossessed if you do not keep up repayments on your mortgage or any other debt secured on it. There may be a fee for mortgage advice. The actual fee you pay will depend on your circumstances. The fee is up to 1%, but a typical fee is 0.3% of the amount borrowed.